After spending 5 decades in banking and managing over $4.1 trillion in assets at JP Morgan Chase, I've come to a fundamental realization that most investors, economists, and even fellow bankers don't fully grasp. If you don't understand gold, you don't understand money. And if you don't understand money, you cannot properly evaluate risk, make sound investment decisions, or protect wealth in an increasingly unstable monetary system. This isn't romantic attachment to a barbarous relic, as Keynes called gold. This is hard-nosed analysis based on thousands of years of monetary history, current central bank policies that defy economic logic, and the mathematical impossibility of infinite debt growth in finite economies. As someone who has navigated multiple financial crises and watched central banks repeatedly destroy purchasing power through monetary experiments, I can tell you that gold represents far more than an investment commodity. It represents the fundamental nature of money itself. Most people today think money is whatever governments say it is. They accept that central banks can create currency units infinitely, that debt can grow faster than GDP indefinitely, and that asset prices can be permanently supported through monetary accommodation. These beliefs reflect dangerous misunderstanding of monetary principles that gold has embodied for over 4,000 years. Today, I want to explain why gold remains the ultimate monetary asset, why our current fiat currency system is reaching its mathematical limits, and why understanding gold's monetary role is essential for preserving wealth in the coming monetary reset that I believe is inevitable. The fundamental nature of money, what gold teaches us. To understand why gold matters, you must first understand what money actually is. Money is not currency, credit, or government promises. Money is a technology for storing and transferring economic value across time and space. Throughout history, various commodities served as money: shells, cattle, salt, silver, but gold emerged as the dominant monetary standard because it possesses characteristics that make it superior to all alternatives. Gold is scarce, but not too scarce. Annual gold production represents approximately 1.52% of existing above-ground stocks, providing modest inflation while preventing deflation. This ratio has remained remarkably stable throughout history, creating predictable monetary conditions that allow economic calculation and long-term planning. Gold is durable. Unlike agricultural commodities or livestock, gold does not decay, spoil, or die. Gold coins minted 2,000 years ago retain their full metallic content today. This permanence makes gold suitable for storing value across decades and centuries. Gold is divisible and portable. Gold can be divided into smaller units without losing essential properties. High value can be stored in relatively small physical space. A single ounce of gold, worth approximately $2,000 today, can be easily transported anywhere in the world. Gold is recognizable. Gold's unique physical properties, color, weight, malleability, resistance to corrosion, make it easily identifiable and difficult to counterfeit. This recognizability enables acceptance in trade without complex verification systems. Most importantly, gold is limited by nature, not human decisions. Unlike fiat currencies that can be printed infinitely, gold supply is constrained by geology, mining technology, and physics. No government, central bank, or monetary authority can create gold through accounting entries or policy decisions. These characteristics explain why gold spontaneously emerged as money in civilizations across the globe, despite no communication or coordination between them. Gold wasn't chosen as money by governments or central planners. It was chosen by markets, traders, and individuals seeking the most effective way to store and exchange value. The gold standard, how real money actually worked. For most of human history, money was gold, silver, or currency directly redeemable for these metals. The classical gold standard, 1870-1914, represents the closest approximation to a pure market-based monetary system in modern history. Under the gold standard, currency units were defined as specific weights of gold. A dollar, pound, or franc represented legally defined gold quantities claimable by any currency holder. Governments couldn't arbitrarily change these definitions without risking capital flight and currency collapse. This system created automatic constraints on government spending and monetary expansion. Countries spending beyond their means experienced gold outflows as trading partners demanded real money rather than promises. These flows forced fiscal discipline that prevented today's massive debt accumulations. The gold standard also created automatic trade adjustments and stable long-term prices. Real wages rose consistently as productivity improvements translated into increased purchasing power rather than currency debasement. The gold standard ended not because it failed economically, but because it constrained government spending during World War I. Rather than limiting spending to available resources, governments suspended gold convertibility to print currency for war financing. This temporary suspension became permanent policy, fundamentally altering the relationship between money, government, and economic activity. Fiat currency, the great monetary experiment. The current fiat currency system represents a grand experiment in monetary policy that has no historical precedent for success over extended periods. Since President Nixon ended dollar-gold convertibility in 1971, the global economy has operated on pure fiat money, currency backed by nothing more than government promises and legal tender laws. This system grants central banks unprecedented power to manipulate money supply, interest rates, and credit conditions. The Federal Reserve's balance sheet has expanded from $50 billion in 1971 to over $8 trillion today, a 160-fold increase that dwarfs economic growth, population growth, or any measure of real economic activity. The consequences of this monetary expansion appear in asset price inflation, wealth inequality, and financial system instability that were unknown under the gold standard. Real estate prices have increased far beyond income growth, stock market valuations have reached historically extreme levels, and debt to GDP ratios have reached levels that would have been impossible under gold standard constraints. Most concerning is the addiction to debt that fiat money enables. Global debt has reached $300 trillion, representing over 350% of global GDP. This debt burden requires continuous refinancing at artificially low interest rates maintained through central bank intervention. Any significant increase in interest rates threatens to trigger debt defaults that could collapse the entire financial system. Central banks have responded to each crisis by increasing monetary stimulus, lowering interest rates further, and expanding balance sheets more aggressively. These policies provide short-term stability but create larger imbalances that require even more extreme interventions over time. We've reached the point where central banks cannot normalize monetary policy without triggering systemic crisis. The mathematical impossibility of this system is becoming apparent. Debt cannot grow faster than GDP indefinitely. Interest rates cannot remain below inflation rates permanently. Asset prices cannot appreciate faster than underlying economic fundamentals forever. These trends must reverse, either through controlled policy changes or chaotic market forces. Gold's performance during every major monetary crisis. Throughout history, gold has provided protection during periods of monetary instability, currency debasement, and financial system crisis. This protective function reflects gold's role as money rather than its industrial or decorative uses. During the 1970 stagflation period, when Federal Reserve monetary policy lost credibility and inflation reached double digits, gold appreciated from $35 to over $800 per ounce. This wasn't speculation or manipulation, it was market recognition that dollars were losing purchasing power relative to real money. The 2008 financial crisis demonstrated gold's defensive characteristics in modern financial markets. While stock markets fell 50% and real estate values collapsed, gold maintained its value and began a sustained appreciation that continued until central bank intervention stabilized financial markets through unprecedented monetary expansion. More recently, gold's performance during the COVID-19 pandemic illustrated its role as crisis hedge. As central banks implemented unlimited quantitative easing and governments borrowed trillions for fiscal stimulus, gold appreciated from $1,500 to over $2,000 per ounce, reflecting concerns about currency debasement and monetary system stability. Gold's crisis performance isn't coincidental. It reflects fundamental monetary principles. When confidence in fiat currencies declines, capital flows toward assets with intrinsic value and no counterparty risk. Gold represents the ultimate such asset with 4,000 years of monetary history and no dependence on government promises or financial system functioning. Central banks understand this relationship, which explains their continued gold accumulation despite public statements dismissing gold's monetary role. Central bank gold purchases reached record levels in recent years, with Russia, China, Turkey, and other countries significantly increasing their gold reserves. These purchases reflect official recognition that gold retains monetary functions that fiat currencies cannot replicate. The relationship between gold prices and real interest rates further demonstrates gold's monetary characteristics. When real interest rates are positive, opportunity costs of holding non-yielding gold are significant. When real interest rates are negative, as they have been for most of the past decade, gold becomes attractive relative to bonds, bank deposits, and other yielding assets that lose purchasing power over time. Modern portfolio theory and gold strategic allocation. From an institutional portfolio management perspective, gold provides diversification benefits that justify allocation regardless of monetary philosophy. Gold's low correlation with stocks and bonds improves risk-adjusted portfolio returns while providing protection against tail risks that traditional assets cannot hedge. Our quantitative analysis at JP Morgan suggests that gold allocations of 5–10% reduce portfolio volatility while maintaining or improving long-term returns. This optimization occurs because gold performs well during precisely those periods when traditional assets perform poorly: financial crises, currency instability, and inflation episodes. Gold also provides protection against political and regulatory risks that increasingly threaten financial assets. Governments facing fiscal crises may impose capital controls, currency restrictions, or wealth taxes that reduce the value or accessibility of financial assets. Physical gold held outside the banking system provides wealth protection that financial assets cannot offer. The insurance characteristics of gold become particularly valuable for high net worth individuals and institutional investors with substantial exposure to financial assets. These investors face concentration risk in financial systems that depend on government stability, central bank competence, and currency acceptance. Gold allocation provides hedge against systematic failures that could impair entire financial systems. However, gold allocation requires understanding gold's monetary role rather than treating it as commodity investment. Gold doesn't generate cash flows like stocks or pay interest like bonds. Gold's value derives from its monetary characteristics: scarcity, durability, portability, and independence from government promises. Investors who understand these characteristics can better evaluate gold's performance during different economic scenarios. Digital currencies versus gold, competing monetary systems. Bitcoin and other cryptocurrencies claim to provide gold's monetary benefits while addressing its physical limitations. These digital assets offer rapid transfers, precise divisibility, and resistance to government confiscation that physical gold cannot match. Bitcoin's supply limitation mimics gold's scarcity, with maximum supply of 21 million bitcoins coded into protocol. This artificial scarcity attempts to replicate gold's natural scarcity without geological constraints. However, cryptocurrencies face challenges that gold has solved through 4,000 years of testing. Digital currencies depend on electrical power, internet connectivity, and technological infrastructure that may be unavailable during systemic crises when monetary hedges become most valuable. Cryptocurrency acceptance remains limited compared to gold's universal recognition. Regulatory risk represents another difference. Governments cannot ban gold ownership without extreme measures, but cryptocurrency bans can be implemented through legislation targeting exchanges and financial institutions. Volatility differences also distinguish these alternatives. Gold volatility averages 15–20% annually, while Bitcoin often exceeds 80–100%. This makes cryptocurrencies unsuitable for many monetary functions requiring stable value storage. The competition reflects broader competition between monetary systems rather than investment choices. Both offer alternatives to fiat currencies, but serve different risk preferences within portfolio construction strategies. Investment implementation, practical gold allocation strategies. Understanding gold's monetary role should inform allocation decisions and implementation strategies. Gold investment can take multiple forms with different risk-return characteristics. Physical gold ownership provides purest exposure to gold's monetary characteristics. Gold coins and bars offer direct ownership without counterparty risk, but require secure storage, insurance, and transaction costs that may be prohibitive for smaller allocations. Gold ETFs provide convenient exposure without storage responsibilities while offering liquidity and transaction efficiency. However, ETF shareholders face counterparty risk that reduces gold's independence characteristics. Gold mining companies offer leveraged exposure through operating businesses that may outperform gold during price appreciation. Quality miners with low-cost operations and strong balance sheets can provide inflation protection while generating cash flows. The optimal implementation depends on investment objectives and portfolio size. Conservative investors might emphasize physical gold and ETFs. Growth-oriented investors might include mining companies for leverage. Institutional investors might use futures for tactical adjustments. Gold allocations require long-term perspective and understanding of gold's monetary role. Gold performance correlates with monetary instability rather than economic growth. Investors must evaluate gold within this monetary framework rather than traditional investment analysis. The coming monetary reset, why gold will reassert its role. Based on my experience managing capital through multiple financial crises and studying monetary history, I believe we're approaching a fundamental reset of the global monetary system. The current fiat currency system has reached mathematical limits that cannot be sustained indefinitely. Government debt levels require perpetually low interest rates to remain serviceable. These artificially low rates create asset bubbles, encourage excessive leverage, and misallocate capital on a massive scale. Central banks cannot normalize interest rates without triggering debt defaults and financial system collapse. Inflation is returning despite central bank efforts to maintain price stability. Supply chain disruptions, energy transition costs, and demographic changes are creating structural price pressures that monetary policy cannot address. Central banks face impossible choices between allowing inflation to erode currency purchasing power or triggering recession through interest rate increases. International monetary cooperation is breaking down as countries pursue competing national interests. China and Russia are developing alternative payment systems, accumulating gold reserves, and reducing dollar dependence. These developments threaten the dollar's reserve currency status and the international monetary system built around dollar hegemony. The monetary reset will likely involve some combination of debt restructuring, currency revaluation, and return to asset-backed monetary systems. Gold will play a central role in this reset, either as direct monetary backing for new currency systems or as reserve assets that provide credibility for reformed fiat currencies. Investors who understand gold's monetary role will be positioned to preserve and grow wealth during this transition. Those who view gold as merely a commodity or inflation hedge will miss the fundamental monetary transformation that's approaching. Understanding this distinction between money and currency, between intrinsic value and government promises, between natural scarcity and artificial creation is essential for navigating the monetary challenges ahead. If you don't understand gold, you don't understand money. And if you don't understand money, you cannot properly evaluate the risks and opportunities in our current monetary system or position yourself for the inevitable changes that lie ahead.